George of the jungle, strong as he can be.
Let's start talking about, and then you tell me when you want your chart up, George.
Yeah, so there were basically two categories, and that I wanted to just share some information. And one of them is kind of the macro view with, the market in general and rates and loan limits and stuff like that. I'll maybe close with that, but the one thing I wanted to talk about on the micro side of things, and this is just me getting on my, podium here, every January, every February. And I just had a conversation. I'm reaching out. I'm physically calling all of my past clients, going through the list and at least, dropping a message or doing something, trying to get in touch with them. But there's been enough changes in the underwriting guidelines that are favorable if you are purchasing a home. Okay, and favorable in the way of somebody who would either itemize their tax returns or somebody who has self-employment income. And just for example, yesterday, pre-qualified a couple of buyers, self-employed borrowers. The guy, it's a husband and wife on one of them, and the other one's just another guy. But anyway, they both of them had a situation where they had a huge increase in income from 2019 to 2020. And if I was looking at the 2019 tax return, if I had to average both years, let's just say that I've got 1 year that's 50,000 and the other year is 150,000. Well, that's a 2-year average of 100. Okay, but they're wanting to get into the higher end price range of homes. They're looking at 600,000 to 800,000. And so it boils down to, okay, are we going to take a 1-year average on the income or a 2-year average on the income? And I'm seeing more and more flexibility on being able to qualify people with 1 year of tax return. So there's the converse of that too. What if somebody had a really good year in 2019 and then did not so well in 2020? Okay, declining income is always a red flag. Okay, that's always, oh no, somebody's going out of business. Well, there were a lot of people affected by COVID. Probably more people were affected negative than they were positive. But if somebody's self-employed and they had, if they had 150 in 2019 and only 100 in 2020, under the stricter underwriting guidelines that we had just even 2 or 3 years ago, that person had declining income and probably was not going to be able to do it. But if their credit's good, if they've got a decent down payment, if they've got some reserves, we're only looking at 1 year tax returns. So we don't know from the prior year whether they had an increase or a decrease. And so what I've been calling people and asking them is that if there's any chance that you might be buying or refinancing, or if you know somebody else who might be, if you have self-employed income, if you itemize your tax, if you itemize your deductions on your tax return, call me, because let's run it through. Let's take a look at your situation. And if you don't qualify right now, based on what you think you might have for your 2020 income, let's put you in a position where you only need to use 1 year of tax returns. Because what that could do for somebody that had a really good year is that, unfortunately, some people have to dial back their deductions, take less deductions so they can show more income, because they know that, well, I need to show enough to the bank to be able to qualify, because they had to use that 2-year average. It's a big difference. When you only have to look at 1 year of tax returns, then all we're not looking at a movie, we're looking at a snapshot, we're looking at a picture. And there's a lot of people that can, both of the ones that I did yesterday, I got a 1 year waiver with 2 self-employed borrowers, and they only have to put down 10%. Now they're good buyers, okay? They've got, high 700 credit scores. They've got money in the bank beyond their 10% down, and their debt ratios were good. But their self-employed income from 2019 was in both cases was low. It was quite a bit lower. So they sent me their draft of what they were going to file for their 2020 tax return. And I said, okay, well, let me go in and put in a 2-year average on that. And basically I was able to get back to both of them and just tell them, look, you don't have to claim that much income because I only need 1 year of tax returns. So that's really good news for people who are self-employed that want to go to their CPA and say, hey, yeah, if I've got some deductions here that we can, if I can lower my taxes, let's lower my taxes because I'm still going to qualify. So
that's because of the 1 year versus the 2 year average. Because we had, like you said, 50 1 year and 100 next. So your average is 75. But because you don't need, you can just
Otherwise,
say
I usually-
75 on your second. If 75 is all you need, well, then your second year, you don't need to claim 100. You
Right.
can write it down. That's beautiful. That's
Right.
beautiful.
So and it used to be you could only get that 1 year tax waiver. You could only get it with Freddie Mac. Fannie Mae would never, they didn't even have it. It wasn't even available. Now Fannie Mae and Freddie Mac, they're both conventional lenders, but they both will do the 1 year tax waiver. Used to be you had to have 25% down. Then we started getting it with 20. Well, now we're getting it with 10% down. We're getting them with 10% down. So that's huge. And the other part of this equation is that once your tax return is filed, okay, you cannot file an amended tax return that increases your income while you're getting a mortgage loan. It gets kicked out. So,
Right.
so once the bullet's out of the gun, once the tax return has been filed, you cannot get it back. So you're going to, I just see it all the time. People, they'll file a tax return. They go, oh, I actually made much more than that. Let me go file an amended tax return. And the
Right,
underwriter,
trying to qualify for more money.
they'll throw it right out because they know what people do. They amend the tax return, close on a loan, and then they amend it back to showing what they were back there. And it's just, and it's just, underwriters are not unintelligent. And the underwriting guidelines don't come into play just out of happenstance. They go and anytime that there's a loan that goes into default or foreclosure, there's a forensic audit done on that file and find, okay, where did we miss something? Why was this person good credit, good job, and everything else? And all of a sudden now we're taking this house back. What happened on it? And then that's where underwriting guidelines come from. They come from doing audits on the deals that went bad.
Right, the dead deal autopsies.
Right. So anyway, anybody that's got any inkling of doing anything, if your clients do, you have clients that are self-employed, it would be a huge benefit for them to know where they need to be on a 2020 tax return if they only have to file 1 year, because they might not have to show as much income. Maybe they take a few less deductions because they need to show a little bit more. But it's a combination of income, debt ratios, and credit score and reserves. So money in the bank after you close the transaction. Somebody that's got 6 months of payments left in the bank versus somebody who's putting down 10%. It takes every dime out of there. It's not required to have that. We don't have to have the reserves to be able to get the loan approved, but that can be the difference between taking a 2 year average and a 1 year average. So there's just some little elements that everybody on this, if you're a real estate agent, you're self-employed, or you're going to have some self-employment income.
Right.
But, so that's my stump speech.